$50 a week or $200 a month doesn't sound like much, right? For investing, it's absolutely not enough, right? The short answer to this is a big no. What if I told you you can turn this easy to set aside money into financial freedom? Sounds incredible, right? In this video, I will show you how to reach this milestone using 3 of the best ETFs in the market. And in the end, I will show you an ETF that can potentially 3x your monthly income to over $15,000 per month. Stay tuned. Before we dive into the specifics of each ETF, let's quickly cover what ETFs are and why they are such a powerful investment tool. ETFs, or exchange-traded funds, are investment funds that trade on stock exchanges, much like individual stocks. They hold assets such as stocks, commodities, or bonds, and generally operate with an arbitrage mechanism designed to keep trading close to its net asset value. Through deviation, though deviations can occasionally occur, the beauty of ETFs is that they offer the diversification of mutual fund with the flexibility and liquidity of a stock. There are several reasons why ETFs are an excellent choice for passive income. First, they provide instant diversification, spreading your investment across a range of assets, which reduces risk. Second, ETFs typically have lower expense ratios compared to mutual funds, meaning more of your money is working for you. Third, many ETFs pay dividends, which can be reinvested to compound your returns over time. In short, ETFs combine the best features of stocks and mutual funds, offering both growth potential and income opportunities. After an in-depth review of more than 20 of the best ETFs available, I've pinpointed the top 3 ETFs that have the potential to turn a $200 monthly investment into a powerful wealth-building tool. These ETFs have been selected for their strong performance, resilience, and growth prospects. Let's start with our third best ETF, the Schwab US Dividend Equity ETF, or SCHD. This ETF is a premier choice for investors looking for a blend of growth and income. Managed by Schwab ETFs, this fund aims to track the performance of the Dow Jones US Dividend 100 Index. This index includes 100 high dividend yielding US stocks, each selected for its fundamental strength, such as financial health, dividend yield, and consistent dividend payments. This selection process ensures that the ETF comprises top performing companies known for their reliability and strong financials. The strategy for this ETF is simple. Focus on investing in high quality dividend paying stocks, which allows it to offer both capital appreciation and a steady stream of income. The ETF's expense ratio is impressively low at 0.06%, making it one of the most cost-effective options available. Lower expenses mean that more of your money remains invested, contributing to higher overall returns over time. Performance-wise, SCHD has delivered a notable price return of 112.65% over the past 10 years. This strong performance underscores the effectiveness of this strategy and the quality of its holdings. The ETF's current dividend yield is 3.48%, with a 4-year average yield of 3.26%. It pays dividends quarterly, and investors can opt for the Dividend Reinvestment Plan, or DRIP, to automatically reinvest dividends and compound the returns. The ETF's dividend growth is also impressive. Over the past 3 years, SCHD has achieved a compound annual growth rate of 9% in dividends, and over the past 5 years, the growth rate has been 12.88%. This consistent growth not only provides a reliable income stream, but also helps to counteract inflation. SCHD is well diversified across various sectors. Its largest allocations are in financials, healthcare, consumer defensive, and industrials. The top 10 holdings, which include companies like the Home Depot, Amgen, and BlackRock, represent 40.19% of the fund's total assets. This diversification helps mitigate risks and provides exposure to different segments of the economy. The ETF's focus on financials includes giants like BlackRock and JP Morgan Chase & Co., known for their stability and consistent dividend payouts. The healthcare sector, with companies such as Amgen Inc. and AbbVie Inc., benefits from long-term trends like an aging population and increased healthcare spending. Consumer defensive companies like the Home Depot provide stability, as they sell essential goods that are always in demand. In terms of resilience, the industrial sector features companies like United Parcel Service Inc. and Lockheed Martin Corp., which add a layer of stability through their involvement in both commercial and defensive activities. Additionally, energy companies like Chevron Corp offer diversification benefits and the potential for higher yields, especially when energy prices are favorable. Over the past year, SCHD has returned 12.21%, and over 3 years, it has provided a return of 9.13%. The 5-year and 10-year returns stand at 52.14% and 111.13%, respectively, showcasing its ability to generate substantial returns over different time horizons. With a dividend growth rate of 3.48% and 10 years average dividend growth rate of 11.01%, here's how the future projections look for SCHD. Assuming you invest $50 per week or $200 per month, the total annual investment would be $2,400 per year. Over a 10-year period, this investment grows to $42,158, given that dividends are reinvested. Over 20 years, the investment would grow to $192,733. And over 30 years, it could potentially reach $856,688. The dividends after 30 years would amount to approximately $63,967 annually, translating to a monthly dividend income of about $5,331. The total value added over the 30 years would be $784,688, with $402,630 coming from capital appreciation and dividend reinvestment accounted for $382,058. These are no doubt solid returns, but can our next ETF beat that? In the end, I will show you an ETF that has the potential to 3x this value. Let's get into it. The next ETF on my list is Invesco Dorsey Right Financial Momentum ETF, or PFI. This ETF offers a unique approach to investing by leveraging the power of momentum within the financial sector. It is designed to expose investors to companies within the financial sector that exhibit strong relative strength characteristics. Here's why PFI is a solid investment choice and how it can contribute to long-term growth. Managed by Invesco, PFI aims to track the performance of the Dorsey Right Financial's Technical Leaders Index. This index is comprised of approximately 30 to 50 U.S. financial sector stocks that show strong relative strength characteristics. Relative strength measures a stock's performance compared to the overall market, indicating stocks that have outperformed others. By focusing on these top-performing financial stocks, PFI aims to capitalize on the trend-following behavior of the market. PFI's investment strategy is rooted in momentum investing, a strategy that involves buying securities that have had high returns over the past 3 to 12 months and selling those that have had poor returns over the same period. The idea is that stocks that have performed well recently will continue to perform well, while those that have underperformed will continue to do so. This momentum strategy can potentially lead to higher returns by riding the wave of strong performing stocks. The expense ratio of PFI is 0.60%, which is relatively higher compared to other ETFs, but is justified by the active management and unique strategy it uses. Despite the higher expense ratio, PFI has shown strong performance, delivering a price return of 81.41% over the past 10 years. This performance reflects the effectiveness of this momentum-based strategy within the financial sector. PFI's current dividend yield is 2.11%, with a 4-year average yield of 1.61%. It pays dividends quarterly, providing a steady income stream for investors. The ETF's dividend growth has been impressive, with a compound annual growth rate of 22.96% over the past 3 years and 19.36% over the past 5 years. This consistent growth in dividends makes PFI an attractive option for income-focused investors as well. The ETF is heavily concentrated in the financial sector, with 87.61% of its holdings in financial stocks. This concentration allows PFI to fully capture the potential of the financial sector's momentum. Additionally, the ETF has smaller allocations in real estate and industrials, providing some level of diversification. PFI's top holdings include leading financial institutions such as MasterCard, Ares Management Corp., and JP Chase & Co. These companies are known for their strong financial performance and stability, which represents 5.12% of PFI's holdings, is a global leader in payment processing and has consistently delivered robust earnings and revenue growth. Similarly, JP Chase & Co., another top holding, is one of the largest and most diversified financial services in the world, known for its resilience and consistent dividend payouts. One of the key strengths of PFI is its ability to adapt to changing market conditions. The ETF is rebalanced quarterly to ensure that it remains focused on the strongest performing stocks. This regular rebalancing helps the ETF stay aligned with the momentum strategy and capitalize on emerging opportunities within the financial sector. This dynamic approach helps PFI stay ahead of the competition and maintain its performance over the long run. The performance metrics of PFI further underscore its attractiveness. Over the past 3 years, the ETF has returned 20.15%, and over 3 years, it has provided a return of 5.44%. The 5-year and 10-year returns stand at 35.16% and 80.56% respectively. For dividend investors, it has a current dividend yield of 2.11%, backed by 10-year average dividend growth rate of 13.95%. Based on these metrics, here's the breakdown of future projections. If you invest $50 per week or $200 per month over 10 years, this investment could grow to $37,402. Over 20 years, the investment would grow to $166,927. And over 30 years, it could potentially reach $1,077,002. The dividends after 30 years would amount to approximately $106,826 annually, translating to a monthly dividend income of about $13,402. The total value added over the 30 years would be $1,005,002, with $313,484 coming from capital appreciation and the majority portion, which is $691,519, coming from dividend reinvestment. And now, finally, the best ETF of all for $50 a week strategy is ProShares S&P 500 Dividend Aristocrats ETF, or NOBL. This ETF is an exceptional choice for investors seeking stability and growth through reliable dividend-paying stocks. Managed by ProShares, this ETF focuses on the S&P 500 Dividend Aristocrats Index, which includes companies that have consistently increased their dividends for at least 25 consecutive years. This commitment to dividend growth makes NOBL an attractive option for long-term investors. NOBL's strategy centers on investing in high-quality, blue-chip companies with a proven track record of dividend increases. This focus on dividend aristocrats ensures that the ETF holds companies that have demonstrated their ability to generate consistent and growing income. Such companies tend to have strong financial health, resilient business models, and the ability to navigate various market conditions, which is crucial for long-term stability and growth. The expense ratio of NOBL is 0.35%, which is reasonable given the quality of its holdings and the stability it offers. Over the past 10 years, NOBL has delivered a price return of 118.73%, reflecting the strength and reliability of its underlying assets. The current dividend yield is 2.12%, with a 4-year average yield of 2.03%. It pays dividends quarterly, providing investors with a regular income stream. One of the key strengths of NOBL is its impressive dividend growth. Over the past 3 years, NOBL has achieved a compound annual growth rate of 6.23% in dividends. And over the past 5 years, the growth rate has been 8.68%. This steady growth in dividends is a significant factor for investors seeking a reliable income stream that can keep pace with or outpace inflation. NOBL is well diversified across various sectors, which helps mitigate risks and provide exposure to different segments of the economy. The largest sector allocations include consumer defensive, industrials, financials, and basic materials. This diversification ensures that the ETF is not overly reliant on any single sector, which is crucial for long-term stability. The top 10 holdings of NOBL include well-established companies known for their strong financial performance and consistent dividend payouts. These companies are leaders in their respective industries and have a long history of dividend growth. The consumer defensive sector, which is the largest allocation in NOBL, includes companies like Walmart and Colgate-Palmolive. These companies sell essential goods that consumers continue to buy regardless of economic conditions, providing stability and reliable income. The industrial sector, represented by companies like C.H. Robinson Worldwide and NextEra Energy, adds reliance due to its exposure to both commercial and infrastructure-related activities. The financial sector, with companies like S&P Global Inc. and Aflac, offers stability through their diversified revenue streams and strong balance sheets. The performance metrics of NOBL further highlight its attractiveness as a long-term investment. Over the past year, the ETF has returned 6.16%, and over 3 years, it has provided a return of 10.43%. The 5-year and 10-year returns stand at 42.80% and 118.35% respectively, demonstrating the ETF's ability to generate substantial returns over different time horizons. The dividend metrics are even stronger, with a current dividend yield of 2.12% and an average 10-year dividend growth rate of 15.98%. Based on these metrics, if you invest $50 per week or $200 per month over 10 years, this investment grows to $41,185. Over 20 years, the investment would grow to $210,669. And over 30 years, it could potentially reach $1,601,965. The dividends after 30 years would amount to approximately $238,764 annually, translating to a monthly dividend income of about $19,897. The total value added over the 30 years would be $1,529,965, with $560,127 coming from capital appreciation, and the majority portion, which is $969,838, coming from dividend reinvestment. Want to know how to compound your investment and add over $2 million to your portfolio? Click the video on the screen to find out.